Namaste, welcome to Zudella. There is a saying there are two types of participants in the market, one with experience and one with money. But when the tables turn, people with experience will earn money and people with money will earn experience. Nothing can beat experience in market. But there are 5 things which I believe if I would knew earlier, it would have made my journey as a trader easier and would have saved a lot of capital and time for me. So the first one is never label yourself. For everyone, there is a catalyst apart from passion that leads us to market. For me, it was Mr. Buffett and his journey. I started reading about value investing, striving to buy the cheapest stock in the name of deep value in them. When I studied, I was in 11th grade, a period full of free time. One mistake I made was that I labeled myself as a value investor without even giving a try to different things such as trading, price action analysis, options and futures, and just sticking to what is being called as value investing. So one learning I would suggest you guys, if you are a beginner, we must learn from everyone and every source possible, yet respect our own organic process and develop a system that suits us. Because I have personally observed that I am highly affected by the price movement and I am a price trader as well as investor rather than a value investor. Understand the market cycle. During the COVID pandemic, when there was fire around, IT sectors and pharma sector stocks were the first one to lead the market up. There are cyclical stocks such as metal, where if we are not right with the price we enter and the price we exit, we will also be losing the time as well as the money on many stocks such as United Spirits and ITC, which are fundamentally strong on numbers, but they are also stuck in ranges for at least 5 to 6 years. Whereas stocks from Adani Group have at least turned to be a bagger, and some of the Adani Group shares have given more than 5-6x return. In a rising market, we should always try to be with the strongest stock from the strongest sector. So there is a clear difference between why some of the stocks turn out to be heavy in the terms of return they give and some of the stocks are still in range. It is because of the tailwind from the sector which we can observe with price action. Third one is you are only right when you earn profits. Unlike any other field, stock market is a serious business and we can't treat it as a hobby. In starting, many beginners are attracted to penny stocks or stocks which are down 50 to 60% from their high, and they believe that they will make a good trade if they buy them. But any stock which is 50% down or more has all the power to go zero. Understand that making money is more important than being right. For example, you stick to some cheap quality stocks in the name of value, and within next 5 years, it has nothing to offer you but a flat return, whereas index give more than return that you get from your investment. Try to convert your idea into a process which can be used as a system. There is a saying in stock market, people feel but system works. You need to make a system where you are aware of the following questions. First one is, am I a price-based trader or an investor? Will I have the guts to stick to my so-called long-term investment with conviction if the price starts falling? Third one is, whether you are a trader or an investor, make sure you have an answer or a plan to decide what to buy, when to buy, how much to buy what you buy, and the last one is when to sell. And when to sell is the most important that you must know because it affects your trading and your investment journey also. Be clear with the process you will follow and stick to it no matter what. Never ignore the price factor. As Warren Buffett says, what is smart at one price is stupid at another. Investor use the term right valuation and trader use the term right price. But around the corner, both the communities try to get the best price which they are buying at. What price you pay for a stock can make you lead the trade or your investment from the starting, and most of your good trades will be leading from the front. For example, paying 317 for an ITC share in August 2018 was a painful experience, whereas buying Yes Bank at 4 rupees would have been a great 4-bagger return. So if we buy excellent business at brilliant price level, it is a win-win situation, which happens mostly when the market falls or there is a crisis around. Understanding price factors would be easy if we understand the market cycle. Getting an edge with price for a retail participant would be easy if they learn technical analysis with proper risk management. Just the ability to observe and study chart is nothing. There is no conviction or risk management plan to trade. One of the biggest mistakes I made in starting was I was heavily invested in 2 to 3 small cap stocks without even knowing what risk I was taking. And when COVID pandemic selling happened, I was down by 50 to 60% on the aggregate portfolio. The biggest lesson I learned from the mistake was we should think about the risk element first, and return will be a function of the risk we take and the market movement, and that can be done by the two questions. First one is how much quantity of a share you should buy. It is not just that you will buy any number of shares you want, it is upon the risk you take. Let's say for example you want to take 1% per trade as a risk and you have a capital of 1 lakh rupees. So 1% turns out to be 1000. So in every trade you will have a price at which you will be selling, which is generally called a stop loss. So you have to take position as per the stop loss distance from the entry point, and you should make sure that the number of shares you are buying, if you go wrong, you should not lose more than 1%, because in the worst case scenario the at most you can lose is on 12 to 13 trades, and even if you lose on all them, you will just lose 12 to 13% of capital. And you must give importance to asset allocation. Never allocate more than 20% of your capital in any trade, and never allocate less than 5% in any trade. So that way your returns will also not be affected and your risk will be in your control. Thank you. Like, share and comment on the video if you like it.